Okay, welcome to the first episode of Ascentis TV. This is our replacement for the monthly newsletter that was sent to you in the past. Just giving you a richer and more engaging format, hopefully, for us to convey all sorts of topical issues. And I'm going to jump straight into it right now with the chatter that's going on around the job retention scheme and the errors or even fraud that Hmrc believe has been committed. They've paid out about 35 billion so far in JRS claims, and they estimate that 10% of that has been done incorrectly or even fraudulently, and they want the money back. Mark, what's the process for any employer that's made an incorrect claim and wants to pay that money back? How do they go about it in practical terms?
Well, there's two ways that you can report the error to Hmrc. The first one, if you're continuing to make claims under the JRS scheme, you can submit what's called an overclaim with your next claim. So if you're making your claim now for September and you've accidentally included somebody you shouldn't, or accidentally put too many hours down for them, you can simply tick the box as you go through the October claim and make the declaration that you've done an overclaim, and it will just reduce the amount that you get paid this month. If you're no longer making claims, or the error is sizable and therefore it actually outweighs the amount that you'll be claiming this month, then you need to contact Hmrc directly to deal with that. Whoa. You've got until the 20th of October to do that, or 90 days from the point at which you made the erroneous claim. So it's something that while we're in this amnesty period where Hmrc are not going to throw the book at you, if you like, for making these errors. They accept that, you know, we were all under pressure and it was difficult to get these things right. That if you hold your hand up now and say, look, I made this error, then they're not going to take any action. They're just going to happily take the money back and let everything carry on. After the 20th of October, I think things will be different. I think Hmrc will take a much stronger approach to, certainly if they find the error that you haven't reported to them, then we're going to be in a position where there's penalties, and if it's a serious enough offence, they're talking about, police action in terms of fraud and anti-money laundering actions that they might take against people. So certainly something that, if you haven't already done so, review your claims that you've made and just make sure that they are all correct and that you're not going to face any issues in the future.
I've actually, I've already made a couple of those overclaim declarations with Hmrc, and they've been quite amenable over the phone. The process is relatively straightforward. The hardest part of it is getting hold of Hmrc, so a lot of the times you've had to ring up and ask for a call back. But that process, they don't seem to be too judgmental at this point. They just give you a 10-digit reference, I think, which you then just use that to pay across using the normal bank details for Hmrc.
Not just in terms of job support scheme, but there was a raft of extensions to all of the government support announced on the 22nd. Lee, you were going to talk to us about the VAT.
So yeah, I think one of the welcome changes that was made was the deferral of the VAT kind of bubble liability that we had. We had this situation where coronavirus kicked in and there was all that uncertainty. So they deferred that VAT quarters, whether it was March, April or May. The payment due in that quarter could have been deferred until 2021 at that point. But that all that debt needed repaying by the 31st of March 2021, which we're not too far away from now. And what we were seeing with businesses were building up this balance sheet of VAT debt that is going to have this consequence when we get to the repayment term that we're going to have a double VAT liability. People, in all good hope, have started to trade again. So the March quarter VAT return would have been hopefully back to normal. They'll have had the March 2020 VAT return, which again was a normal trading VAT return. So that would have been a real double hit in terms of VAT liability that they've had to pay. So what they've done now is they've extended this VAT that's been deferred another 11 months from there. That's interest free, and so it just helps really smooth over that cash flow of this initial kind of liability that we'd built up in terms of VAT debt, and obviously there's other debt that's been picked up as well, such as January 2021 we had this big self-assessment liability that was due that all the directors. Yeah, so there's the July deferment, and then there was going to be the January payment on account as well, but that's been deferred as well, I believe. I don't know if you've got any more details.
Yeah.
On that.
So where you, even if whether you've deferred your 31st of July payments on account or not, any payments that were falling due 31st of January 2021, where you owe less than £30,000, whether that's a combination of a deferred 31st of July payment or just your 31st of January payment, there's now an automatic 12-month time to pay arrangement where you can pay that 31st of January payment over the next 12 months from the 31st of January. If you owe more than 30,000, that isn't necessarily closed to you as an avenue. It's simply that you must speak to Hmrc about agreeing what they will accept in terms of a time to pay arrangement. I think the likelihood is they'll want some sort of upfront payment and then allow you to defer the rest over 12 months. So.
Yeah, one of the key things of this VAT deferment, there's no finer details on this yet, but it is an opt-in scheme. So every business is going to be eligible, but you will have to opt in to Hmrc in order to take advantage of that 11-month period. But I mean, that was just one part of the financing that they made available. They've extended all the other borrowings as well. I think, John, you had some more details on those?
Yeah, well, Q1 and Q2 of 2021 was going to be the real pinch point. This is when not only VAT, as you mentioned, was due to be repaid, but also people that took out the bounce back, the B-bill loan, or the C-bills loans back in sort of March, April, May time, their repayments are going to start in that period as well. Mm-hmm. In addition to that, there is the deferment of income tax payments that were due on the 31st of July. They were due to be paid in that period as well, and businesses that perhaps have got arrangements with their landlords to defer rent, even with other suppliers. So there's going to be this real squeezing point of cash flow between January and June time next year. Hence, that's why on the last COVID video report that I did to you guys, we were saying how important it was to really now focus on your cash flow forecasting using whatever tools you've got. If you've got cloud accounting, like all of our clients have, then you've got Fluidly, professional version. It's a plug and play cash flow forecasting tool. And I was just emphasising how important it was to look at Q1 and Q2 and whether you needed additional finance. So there's been some more announcements that is going to make people's lives a lot easier. So this is a brief recap on the C-bills, which is the bigger loan of the two, which was the £50,000 to £5 million loans, full credit application that you had to go through, so business plan, cash flow forecasts, and what have you. And then it's the junior version of this came out shortly afterwards, the bounce back, and literally anybody with a pulse could get one of these. 3-minute application form that you fill in online, just ticking loads of boxes, and for the majority of people, 24 hours later, you could have up to £50,000 in your bank account. Just to recap on some of the subtle differences as well, the B-bills, which is the 50 grand one, that was fully guaranteed, is fully guaranteed by the government. Interest-free for the first 12 months, 2.5% interest payable over the term of 6 years, and you could repay the whole lot at any point in time. So loads of people just got them speculatively anyway and have got the 50 grand still sat in their bank accounts. The C-bills is, after B-bills was introduced, went up to 50,000, £50,000 and a pound, I think, up to £5 million. That one is 80% guaranteed by the government. The interest rates are variable though. We're seeing some startling interest rates of 15-20% by some of the lenders in the early days. Same 6-year repayment terms, and a lot of them also had capital repayment holidays for the first 12 months.
So what if you, like with the bounce back loan, if you'd taken out not the full £50,000, if you'd only taken out £10,000 at that point in time, that's what you thought you only needed in terms of working capital, and you want to borrow more on top of that bounce back loan. I don't think you can take out a second bounce back loan, can you?
Well, the announcements that were made have now synchronised the application deadline that you can make for a C-bill or a B-bill. It's now all the 30th of November. In addition to that, the loan repayment terms have gone from 6 years to 10 years. You can opt to take a 10-year version. That's going to halve the repayments that people make under these loans. So the announcements have made a lot of people sit up and think, actually, did I get enough? And also reflecting on the fact that we've just gone down into a second, although lighter, measure of restrictions, if you like, which we weren't anticipating back in March, April time. So a lot of people have borrowed too little to get them through these lean times. And with the announcements now saying that you can make an application to 30th of November, a lot of people are looking at what they actually borrowed. So if you took out a B-bills loan, you can't apply for another one, unlike C-bills where you can make multiple applications. So if let's say that you borrowed, I don't know, £10,000 under a B-bills loan, you thought that was going to be enough. You look at that now and thinking, actually, I could have done with a lot more. You can't borrow any more under B-bills. What you could do is you could borrow money under a C-bills. So you could borrow £51,000. If you wanted the whole amount, then all you got to do is repay your B-bills of 10,000, because you can't have a B-bill and a C-bill together. So if you get a C-bill to top up, you've got to pay the B-bill off. And then if 50,000 is too much, after 12 months, you could always make a lump repayment. So you could pay 20 grand off and you've got a 30 grand loan instead.
And just to reflect back on that point about using fluidly, the C-bills applications are a lot more complicated, and you do really need cash flow forecasts and projections for that, don't you?
It's a full credit application, so you'll need a business plan. You will need at least 12 months and ideally 36 months cash flow forecast and projected financial statements. So yeah, the application process is a lot lengthier, and but again, it's up to 250 grand. There's no PGs on it at all. They can ask for PGs over 250 grand, but I think what we're talking about here is people that are wanting to go from a B-bills to a C-bills, and therefore the amounts that they're going to want to increase to are going to be quite modest. No one's going to go from a 10 grand B-bills to a 500 grand C-bills, are they? So yeah, you could just borrow slightly over the 50 to get into the C-bills regime, and then just pay off your B-bills. Okay, so there's been some announcements on behalf of the self-employed taxpayers in the country. Mark, there's a couple of announcements, one around the self-employed income support scheme, and I think there's some additional time to pay arrangements as well. Can you take us through those?
Yeah, so the self-employed income support scheme has been extended again in line with all the other support. So there'll be 2 further grant payments to cover the period November through to April 2021. They've announced the amount of the first grant payment. That's going to be 20% of your monthly averaged earnings. They haven't announced the amount of the second grant yet. We've got to wait to find out how much that's going to be.
The way the pattern's going, it's just going to reduce every time.
Yeah, I don't think it's going to be a great deal. I mean, the grant that's about to be paid next is 20% of your averaged earnings, but it's capped at £1,875, so it's not huge.
I won't be expecting too much from that last one.
No.
The Chancellor also announced the Pay As You Grow scheme, which is basically it's an extension of the 6-year loan terms to 10 years. Interesting enough, it's in either 6 or 10 years to make your loan repayments under C-bills or B-bills. I guess if the repayment profile of 8 years was more suitable to you, then you'd opt for the 10-year repayment. You would make your normal loan repayments, make some payments into your reserve account, and then at year 8 make a big lump sum payment. One of the things that it talks about as well, and Mark, I want to drag you back to the job retention scheme, was the changes that are coming into place from the 1st of November.
Well, as we all know, the furlough scheme as it exists is coming to an end 31st of October. With the recent announcement about the extension to lockdown, the Chancellor was under pressure to produce something that allowed an extension of the furlough scheme, he hasn't extended the existing furlough scheme. That still ends on the 31st of October. What he's done is he's brought a new job support scheme to the table. Now, the new scheme is a lot less generous in the way that it works, and probably going to be a lot less used, to be honest with you. The new scheme, first of all, needs any employee who's going to be brought into the scheme to work a third of their usual hours in order to qualify for the scheme. And where they work for a third of their usual hours, the government will then support paying a top-up of their pay as long as the employer agrees to top it up as well. So of the 2/3 pay that the employee is not receiving because they're not working, the employer will pay a third of those wages and the government will pay a third. The requirement is that the employer will pay the whole of the employer contribution and the government contribution up front and then reclaim the government contribution back. So there's first of all, there's a negative cash flow connotation there. And the second part really of that is that for an employee working a third of the time, they're going to receive 77% of their wages, and 55% roughly of that will be funded by the employer. Now, the employers I've spoken to already about this are not overly enthusiastic about that as a scheme, for obvious reasons. So I'm not entirely sure how many people are going to be interested in using this scheme and how much take-up there is going to be of it. So, John, we've talked about all the enhanced borrowing opportunities for our clients with the C-bills and B-bills extensions. Has there been any changes to what they can actually spend that money on?
Yeah, I mean, there's going to be a lot of clients that are looking at the extended period and thinking, well, I'm going to increase my borrowing. The purpose remains the same. It must be for business purposes, effectively spending on working capital management. So that's the payment of all of the ordinary overheads on a day-to-day basis in the business. And that includes dividends for owner managers, because they're effectively the payment of wages. I think that in the same way that they've seen a review now by Hmrc over the abuses to the JRS scheme, there will come a day of reckoning for any abuses under the B-bills and C-bills scheme. I think they'll only probably be unearthed and pursued for those businesses that fail. I'm reliably informed by our associates in the insolvency world that there's been no instructions given to them yet as to how to deal with this, whether they should specifically look into a business that's failed, had a B-bills or a C-bills and not made any repayments against it. But I can see that coming down the tracks. So for anybody that has taken out a loan and it's sat there in the bank account and they're wondering what to spend it on, just a reminder that it must be spent on things that are for business purposes. That could be investment and growth in the future and all the rest of it. It's not a personal withdrawal of 40 or 50 grand and spent on a holiday or a car or something like that. So it must be for business purposes. I suspect there's going to be some announcements probably next year about the consequences for those people that have abused those two loan schemes. So watch this space, I guess.
Okay, thanks, John.
Okay, so I hope you've enjoyed the first episode of Ascentis TV. If you've got any questions around the topics that we've raised and you want to have a one-to-one with one of the partners, just get in touch in the usual way. If there are any topics that you want us to cover in future episodes, then again, just put those to us. But until next time, bye-bye.
Bye.